For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to the Saturday Sendout from the Simple Side. We've got some weekly market updates for you, as well as some really interesting top stock picks from ETFs, mutual funds, and 13F investors. Let's get into it.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side and end up in first place.
All right, everybody, thanks for joining me. I, of course, am recording this Saturday, February 21st, right around the middle of the afternoon Eastern Time. Before we jump into the short week that happened this week in the markets and some of the major news that hit the timeline, I do want to talk about some quick reminders and things that you should know. So first off, this week's newsletter is being sponsored by Ground Floor, which is a company that offers you the ability to kind of throw your cash into 1 month, 3 month, 12-month notes that are backed by real estate, and they offer yields up to 8.25%. So go and check them out. Of course, like I said, they are a sponsor, and I think they have minimums, maybe $100 or $1,000 minimums. But go and check them out, and I think they give you a nice little extra payday if you use the links that are in the header of the newsletter or at the very top. I also want to remind you that copy trading can be done on autopilot. Our portfolios, our macro indicators, and our research can all be found on thesimpleside.news, which is our website. There are links to those in the newsletter as well, and there should be links to those in the show notes if you're listening on YouTube or Spotify or Apple Music or any of those podcast players. My final reminder / request is that you help me help you. One of the things that I want to do more than anything else with the newsletter is ensure that you are all getting what you want from me. I want you to take a bit of time this weekend to let me know what you think can be improved upon in the newsletter. And all you need to do that is click the survey button that I have included in the newsletter. Just click on that survey button. I'm not asking you a million questions. I'm not collecting your data. I just want to hear from you. There's only one question, and it is basically, tell me whatever it is that you want to say. It can be anything from, I want to have you post more, to I want you to structure your newsletters in such and such way. I'm going to take all of it into consideration and try to improve everything starting next month. I'm going to try to do these maybe once quarterly to try to give improvements to you guys once a quarter throughout the year. So hopefully by the end of the year, we've made 4 big adjustments to the newsletter, and it makes it much more beneficial for you all. All right, enough of that. Let's talk about what we're seeing in the markets. Obviously, a few key things happened this past week, both in the markets and in the portfolios, some good, some bad, and we're going to talk about it all. But before we do, I just want to talk about our quant macro indicator. So for those of you that don't know, I run this very fancy and nerdy statistical model in the background that looks at about 11 to 12 different macro metrics, and then takes all those to estimate what the prices should be for the SPY, which is the S&P 500, GLD, which is a gold, I think it's the SPDR gold ETF, and then TLT, which is a bond ETF. It combines all of those together and then basically says the overall economy is blank. It's a buy, it's a hold, it's a sell, it's a strong sell, it's a strong buy. One of those 3 things. You can find access to this in real time on our website, thesimpleside.news, or if you're following the newsletter, we'll talk about it here as well. So right now we're sitting at a 0.13 level, which of course is a hold. This is the first time that we've shifted out of buy territory for the general economy since I think last week. But we've been wavering between hold and buy, back down to hold, back up to buy, basically since the beginning of the year. The highest level that we've reached so far has been 0.35, which was a buy, but still a far cry away from the max value of 1, indicating that you should be backing up the truck and buying as much marketable securities or assets as you can. And the lowest that we've gone is negative 0.049, which is, of course, nowhere near strong sell territory, which means you should be taking your money and running. I've got an image here in the newsletter of the total macro indicator, which just shows you how it's wavered over the past 3 years. And you can see that for the past couple of months, we've been wavering in between that buy and hold territory. What's frustrating about wavering between the buy and the hold territory is that there's no clear signal whether to buy or sell. Yes, we're in buy territory, but being in buy territory doesn't exactly mean that you should be loading up on stocks. It just means that the economy is relatively strong, at least the way that our quant model sees it. These are basically periods of waiting, but they're not super common. And the last time we saw kind of a limbo period was from April of 2025 to July of 2025, which is about 4 months. And then we saw the indicator jump up into strong buy territory. And of course, we've seen the S&P 500 run quite wildly from then on. And in the current case, we've been in limbo since November of 2025 to now, which is again about 4 months. And so, based on what we've seen historically in the past year, there's a chance that we bump up here into strong buy territory, or we run down into a strong sell territory. Regardless, we'll be paying attention to this and updating you guys if we see any major changes. One of the benefits of being a paid subscriber here at the Simple Side is getting access to a collective of portfolios that we offer. While not all of our subscribers follow these portfolios, some of them just follow us for the weekly picks that we do. Some of them just follow us for the research reports that we put out. But our macro portfolio is one that we introduced at the beginning of 2026 and has outperformed the S&P 500 handily. The current macro portfolio invests in only 3 assets: gold, bonds, and the S&P 500. And it just makes differing allocations in each of those assets every single Friday. It'll adjust those weights. The current portfolio is up about 14% year to date, which is outpacing the S&P 500's return of only 0.74% year to date. You can find this portfolio if you're a paying subscriber on the Portfolios tab of our website, and I've got a link for you right here in the newsletter. And you can see the macro indicators, whether you're a paying or a free subscriber, for free on our website. And then up in the header, you can just go click on the macro indicators tab and it'll take you over there. Enough shilling. We'll talk more about what's happening in the economy that we're looking at. The total macro indicator isn't the only place that we're seeing kind of a missing clear conviction. In the quant model, like I mentioned earlier, we've built out an S&P 500 quant model that kind of says when we think the economy is saying sell or buy into the S&P 500. And right now we've been wavering in the S&P 500 model back and forth between hold, buy, and actually a little bit of sell here and there, which again is nothing to be worried about. But there's just no clear conviction. The last time that we had clear conviction was in early 2025 when we saw the market start screaming strong sell indications, and that led us down into April, where we then saw the strong buy indication start to pick up. And so we're kind of waiting for that to show up again before we make any big moves. But that's about how long we've been 50% in cash. Basically since the beginning of 2026, late 2025, we've been holding 50% cash. And I went ahead and circled a spot on the chart where we kind of started doing that. And it was when the economy started showing that big, strong sell signal. And since then, we really haven't updated. The stock market is up about 16% from the time that we went 50% cash. So a big jump upwards, but in general, we're comfortable being 50% cash right now and losing out on some excess returns because things are unstable and there really is no clear conviction about buying or selling right now in the market. Again, I also think the stock market is devilishly overvalued. One of the charts that I've thrown into the newsletter is something called the Buffett indicator, which shows the ratio of the top 5,000 stocks, the Wilshire 5,000, graphed against the gross national product of the US. And it's just showing a ratio of those two. And so obviously a ratio of 1 would mean the gross national product is about equal to the US market cap that we're seeing from the Wilshire 5,000. I think Buffett likes to invest in this anywhere from 0.9 to 1.1. He said is, kind of go get 'em, go invest range. Right now, we're sitting at 2.21. So we're 200. Basically, what this is saying is that the stock market is overvalued by 221%. Of course, that's all relative, but the reason why we're seeing this huge swing up, especially in the past few years, is the popularization of retail trading and $0 commission trading. And then also the AI super cycle, which just recently started over the past 5 or 6 years. And this is basically leading to lots of people feeling more comfortable that the economy is going to start growing and that they should be throwing money into assets because they're going to be rising in value. And that, of course, means more money in the market for the same marketable securities. And, of course, that means overvaluation. And what happens during overvaluation? Well, the richest people who are making the biggest investments start to make the most amount of money and start to gap those down below. And who are those people? 13F investors, ETFs, and mutual funds. They seem to be the ones that benefit the most from these huge upswings that we see in the market. Now, I work with the team over at insideredges.com very closely. I like what they're doing a lot, and they just recently sent me a list of 5 of the top bought companies by ETFs, mutual funds, and 13F investors for the current quarter. So of the Q4 2025, they sent me the top 5 pick stocks and gave me a little bit of background information, which is after the market crashed in 2022, the ETFs, mutual funds, and 13F investors all seemingly had a perfect grasp on what companies they wanted to buy into, and they bought 5 key stocks in January of 2023. Those 5 key stocks were Meta, or Facebook, Nvidia, Netflix, Amazon, and Adobe. Over the next year, so in 2023, those companies would return 194%, 239%, 65%, 80%, and 77% respectively. That means that an equal weighted portfolio holding just those 5 picks would be up 131% in just 1 year in 2023. It should come as no surprise that they managed to do it again in 2024. They picked only 3 stocks this time, Meta, Nvidia, and Amazon, and an equal weighted portfolio would have gone up 93% in 2024. And last year, 2025, it was more of the same. The portfolio of the top 5 picks would have done 41.33% returns. And now, heading into 2026, the 3 wealthiest groups in the world have spoken again, and they've highlighted a new set of 5 key stocks. And I've got them all here for you. I'm going to present them right now. We're going to talk about them really quick. I'm just going to tell you the amount of investment that we've seen from 13F, ETF, and mutual fund investors. But if you want to go and read the newsletter, I'm going to tell you some interesting stats about each of the stocks. I've given each stock kind of one little graph to go and look at. And then, of course, thrown in some statistics about their fundamentals and whatnot. So if you want to read more, you need to just jump over the newsletter and read it. But if not, you can just hear me talk about each of them. Nvidia, of course, is pick number 1. It was the most bought into stock by 13F filers, and it's up 1.78% year to date, slightly outpacing the S&P 500. 7% of all mutual funds bought into the stock. 12.11% of all ETFs bought into the stock, and 13F filers, over 30% bought into the stock. So huge buys across the board there. The number 2 pick was AppLovin, ticker APP. AppLovin, of course, is an interesting choice. The stock is down 37% year to date. But 11% of 13F filers bought that one. 6% of mutual funds are buying in, and 6% of ETFs bought in as well. And these numbers might not seem super high, but they are. These are very sizable numbers. When you think about the fact that so much money is sent into ETFs, so the stocks that they buy are just receiving tons and tons and tons of capital. The third pick, which is a surprise, a very big surprise that this showed up, was Tesla, ticker TSLA. The stock is down about 8% year to date. And in my opinion, I don't think this is a great company to own, but it doesn't matter. We're talking about mutual funds, ETFs, and 13F filers. So 24% of 13F filers were buying, 6% of mutual funds, and 8% of ETFs were buying in. Some of the large buyers included Renaissance Technology, George Soros, and Mario Gabelli. So worth paying attention to for sure. Pick number 4, AMD Advanced Micro Devices. I'm happy to see this on the list. We hold some of this stock in the tech-focused growth, and maybe we hold it in the EI secondhand effects portfolio. Regardless, it's in one of those two, or potentially in both. And we have 18% of 13F filers buying in, 5% of mutual funds buying in, and 8% of ETFs buying in. These are all, of course, buyers that are big time in the past quarter. Renaissance Technologies and Jefferies Group making large purchases. This is Jefferies Group, I think, 13th quarter in a row buying AMD, and their second largest purchase of the company in history. So definitely one worth paying attention to. And the fifth and final pick, which should come as a huge surprise, but I'm happy to see it on here, is ServiceNow, ticker NOW. ServiceNow is recently just beat up, down over 55% from their highs over the past few years, and down 30% year to date. But like I said, smart money does not seem to care. 13 F filers, 15% of them are buying in, 5% of mutual funds, and 7% of ETFs. Big buyers, we're going to see here, again, Jefferies, Mario, again, and Renaissance Technologies, just to name a few, and there are a lot more big names that we're buying into ServiceNow. Again, down 50% from highs over the past few years. So I don't know exactly how this is going to play out. Of course, ServiceNow is one of the beaten down software companies that people started to sell off, worried kind of about the AI takeover, the AI race. So very, very interesting to see so many big and quote unquote smart money moves going into ServiceNow. Now, an equal weight portfolio of these 5 stock picks would be down 17% year to date. And of course, it's impossible to know what's going to happen tomorrow. And even though there are tailwinds from these smart money buys, and it's never terrible to follow a good tailwind like that, we just have no idea what's going to happen. Of course, we own ServiceNow and AMD, so I'm going to be rooting for those stocks. But if this portfolio is anything like the past, which is a fallacy to think, but if it is anything like the past, you could see a very surprising run from these picks, especially that they're down 17% as a collective through 2026. So, if there's something that these people are seeing that we're not seeing, there's a great chance that these picks will go on to be huge winners in 2026. And I will be paying very close attention to these companies in case they do become assets that we see as potential investments. One of the stocks that I didn't mention that I think was around like 6, 7, like within the first 10, sorry, 6, 7, was in the first 10 companies, I think was Netflix, which we also own, and Intuit was another one that showed up, I think, in the top 10. And we own that company as well, and a few others. So anyway, a lot of software companies being bought, so I'm not super worried about software. I've said that before, but just food for thought, if you will. Again, I always like to highlight our stock research reports. Currently, we only have 4 outstanding picks. 2 of those are in the green, RTX and NEE. RTX being a defense play and NEE being an energy play. And we have 2 picks that are in the red. W, which is Wayfair. Not a lot of people are familiar with that ticker. And then ticker NICE, NICE. Not a lot of people are familiar with that. I think we're going to sell out of NICE here soon and take the loss on that. It's a foreign company, and with all the wars that are potentially happening, Israel, Iran, all that stuff, we might try to remove ourselves from that position, just kind of remove ourselves from the dangers happening abroad. I also have 2 picks that are in the works right now that I hope to send out to you over the next week. But as things always are, you just never know if something's going to change or if I'm going to be able to get that research done and send it out to you. But there are 2 picks coming. One of them is a stock we already hold, and another one is a completely new stock, relatively high risk, high reward companies, both of them. So we'll be sending those out soon. All right. As always, if you're a paying subscriber, this is where you want to jump over the newsletter and look at all the data and information on our portfolios and our weekly picks. Our weekly picks aren't something that we do on autopilot because autopilot only allows me to adjust my portfolios once a week. And these weekly picks would have stocks moving out at least or potentially every single day over the course of a week. So we wouldn't be able to copy trade them there. But we do send out and track all the picks on the website and in the newsletter so you can see verified historical performance. We send out price targets. And then, of course, the stocks. There's 6 of them typically every week. And so you can go find all those there. And we also kind of tell you this trading strategy as well down below. I think that is all I have for you. No major updates on the flagship fund for paying subscribers. For the AI secondhand effects, we're kind of looking at making some moves here. We see some high risk, high reward moves to make. But again, they're high risk, high reward. But we do throw a ticker at you if you're interested in a potential uranium play. And then in the tech-focused growth portfolio, we saw pretty good performance this past week after our recent updates, up around 2% from Friday to Friday. And so we like how that's looking. Again, these are potentially picks for 1, 2, 3, 4, 5 type years. So, pay attention to that. And then, of course, the weekly picks. We're up 86.98% since we started this in 2024. I don't know. It's been 84 weeks. We've been making these weekly picks for 84 weeks. The S&P 500 up 25% over that time period. We are up 86.98%, which is a 61% outperformance. So you can go in and check all of that out there. And I think that's really all that I have for you this week. Again, please don't forget to go and fill out that survey for me. It's very, very important that you guys do this stuff because it means I can make these newsletters so much better for you. I can make these things so much better, and that's all that I want to do. Something that someone just recently emailed me about is to get more stock picks. Basically, like just doing some research on a company and sending it out to you guys and saying, hey, this is a potential good buy. It doesn't have to go in my portfolios. But those research stock picks have done really well. I don't think I told you the stats, but let me scroll down and find these here. We've made 16 total picks, which is not a ton, 10 of which have been winners that have closed, and 12 trades have closed. Of the 12 trades that have closed, our average return is 24.3%. And our win rate right now is 83%. And our best pick was an IPO. It was a Figma IPO, which we returned 142% on. So we'll try to get more stock research reports out to you guys. I'm just debating, do you want to see stock research reports that aren't super in-depth? Maybe I've researched them out well, but I just haven't written them out super well, or just high level, the reason why I like the companies. You guys let me know. I can do a few number of super well researched stocks, and we'll get 16 picks over the course of 8 months, maybe 2 a month. or I don't know, maybe it's been 12 months and you'll really only get about one every other month or something, or about one a month. Or I can send out more and they'll just be a little bit less in depth. I'll still be using some of the same general procedures, DCFs and whatnot. But in general, I want to hear from you guys. Let me know. Fill out that survey for me, please. I'll make the newsletter better for you. I promise. But I think that's all I have for you this week. Thank you guys for showing up, and I will be seeing you next week. Have a good one.